Okay, everybody, let's have a look at the multiple choice questions first of all and see what the solutions were. So, all shares issued by a corporation have voting rights. Well, that's false, specifically right out of the text. The policy making body of a corporation is the board of directors. That's true, again, right out of the book. Dividends in arrears or cumulative preferred shares are not a liability. That's correct, because if the corporation went bankrupt, those dividends would not be paid. So that's true. In a 3-for-1 stock split, the number of shares outstanding triples. That's right, it's a split. And so just the number of shares changes. So the retained earnings account equals all the previous period's net incomes minus any dividends declared less the prior losses. So that's false. A corporation is a separate legal entity apart from its owners. That's true. Repurchase of share capital from shareholders reduces shareholders' equity and increases assets. That's false. We would have a decrease in assets if we had to pay out something. And again, it would reduce the shareholders' equity. Share capital is the investment by shareholders in a corporation. Absolutely. The owners of a corporation are referred to shareholders. These are all either partnerships or some other form, but shareholders are specifically owners in a corporation. The heading contributed capital is what we see in the shareholders' equity section, and right underneath it says preferred shares and common shares. The document used by the government to grant permission to form a corporation is the Articles of Incorporation. Again, right out of the text. The board of directors announces a 3-for-1 stock split on 24,000 outstanding common shares and the average price of $30 immediately after the stock split. And it's right here, average issue price decreases to $10 per share because we've just increased the number of shares that we have. We haven't changed the amount of the dollar amount. So our $30 should drop by 1/3 because of the 3-for-1 stock split. So the entry to record 7,000 common shares should be a credit to common shares for sure, and it would be a debit to cash. Missed dividends on cumulative preferred shares are dividends in arrears. They're not liabilities. They're just referred to as dividends in arrears. Corporation issues 4,000 common shares exchanged for equipment with a market value of 15,000 and an average issue price of $3.90. Market value is the key in all this. So it would be an increase in common shares by 15,000. And again, that's right out of the text. When a corporation declares a 10% stock dividend, retained earnings will be debited for the new shares times the current market value. So again, remember, dividends always get charged against retained earnings. So during 2019, total dividends declared by this corporation amounted to 29,000. There are 40,000 shares of $3 non-cumulative preferred shares outstanding and 10,000 common shares outstanding. No dividends were declared in 2017 or 2018. The total amount of dividends payable to each class of shares in 2019 amounted to, well, there's 4,000 shares and they're non-cumulative, so you don't pay any old ones out, so you just pay $12,000 for the preferred, and the difference between that and the 29,000 is 17,000. That goes to the common, so it's A. Cash dividends are a decrease in both the assets and the total shareholders' equity because we're paying out some of that retained earnings in the form of cash. 2-for-1 stock split, the balance in the common shares general ledger account is exactly the same. The only thing that changes is the number of shares. Dividends become a liability of the corporation on the declaration date, so we accrue that dividend payable at that point. And in this multiple choice, you had to go through the calculations, but basically you're looking for a return on common shareholders' equity. You're looking for C, 32.5%. You go through the math, yeah, you'll find it's there. And same thing here. You'll find that the weighted average number of shares, doing again the math, is 76.25. On this one, what's the earnings per share? Again, if you look at the number of weighted average number of shares, you'll end up with $68.20. And finally, in this one, the book value per common share, again, you go through the calculations, it's $105 per share. And here on ABC Company, again, based on these numbers here, you end up with the maximum cash dividend, of course, being just the retained earnings. That's the maximum you can pay, $126,260. And that was the multiple choice. Now, just on to the questions themselves. So question one, you basically had to pop in some numbers, and the opening numbers here for common shares, 35,000 in common shares. Pref shares was 15,000. Retained earnings, 75,000. And then down here, we had net income. Net income is just going to affect retained earnings. So that's adding 135,000. The dividends come out of retained earnings, and that's the only place they come out. And then the issue of shares increases the amount that we have in common share capital, $25,000. Should have ended up with these totals at the end of the day. On question two, we're talking about reacquiring and then selling more shares. And so this was important to understand the average issue price per share. So in this case, with the common shares, when we are reacquiring these 5,000 shares, we have to go back to that average issue price at $21.75. So this number ended up being $108,750. The cash that we got in this case was, if 5,000 shares at $25 is what we spent to get those shares. So it's a credit to cash, $125,000. Now, in this case, we've got to account for that difference. So the first thing we do is use up the contributed surplus, which had a balance of $10,000 at the beginning of the year, and that would have been a credit. So to get rid of it, we have to debit it for $10,000. And then here in retained earnings, we have to take that, and that's the plug in this case, and it was $6,250. So, and here we'll just pretty this up a little bit, and here we go. So then on the 20th of January, we sold 3,000 shares at $28 a share. So if you do the math, 3,000 times 28, you should get 84,000. So that would be we've got that backwards. We need to do cash first of all. So the debit is to cash, 84,000, get that out of there, and then 84,000 right there. Good. So in other words, we're getting $84,000 in cash because we issued 3,000 shares at $28 a share. And then here, we've got common shares that we are going to reacquire. So we have to go back to the average issue price. And remember, every time we've got a transaction through common shares, we need to record that. So in this case, we're reducing the common shares, and we're reducing the number of common shares. So by those amounts. And here, we're increasing the amount of common shares, and we're increasing the number of shares that we've issued. So in this case, our common share average issue price is now $21.94, being $21.50 divided by 98,000. So then we've now sold these shares. We've now reacquired or repurchased these shares, and so we have repurchased 2,000 shares. The average issue price is $21.94. So in that case, that number is $43,880, and then the cash that we've had to pay out is $20.75 a share, according to the question. So the amount of cash here is $41,500, and then in this case, the difference, the plug, is $23.80, and it goes to contributed surplus because it's a credit in this case. So that's great. If we look at the second part of it is, what's the ending balance in the common share capital? Well, we know it started at 21.75, and then we took 108.75 out of it. Then we added 84,000 to it, and so we end up 2,150,000 before this transaction. And here we have a transaction through common shares, so we've got to take that out of there. And when we do that, we end up with a common share balance of $21,06,370. So $2,106 and $2,106,370. Okay, on to question 3. In this case, we've got this is the dividend question. And so in this case, we've got a dividend. We know the total amount of the dividend is going to be $85,000. They tell us that in the question. The trick here is to know how much in preferred shares you've got to pay, because these are cumulative preferred shares. And they tell you that there have been no dividends paid, which would include pref dividends, for 2017, 2018, 2019, and 2020. So we should have had 4 years worth of dividends, because we're actually doing this dividend December 3rd, 2020. So that means we should have $80,000 worth of pref dividends and $5,000 worth of common. You needed to have this memo entry here for the date of record on January 31st, 2021. And then the actual payment of the dividend, where we just basically debit these dividend payables accounts and credit the cash, you needed to get that number as well. And then the dividends per share, we know that the total amount of dividends here was $5,000 to the common shareholders. And the number of common shares issued is 100,000. So if you do the math, you end up at 5 cents per share. So that's where we ended up. Finally, on question 4, this is the question about looking at a common stock or a stock dividend, basically. And so in this case, because it's a dividend, we know that it's got to be a debit to retained earnings. So if we do the math, which would be 65,000 shares times 15% stock dividend, means that we would issue 9,750 shares, and the market price is $13. So that works out to be $126,750. That's the charge to retained earnings. And you had to catch that the account was common stock dividends distributable as a credit, and then you needed to get rid of it later on and actually issue the common shares. That's the date of distribution. But you also needed to catch this memo entry here on July the 15th, which was the date of record. So if you did that, you'd do just fine. Then the stock split occurs in December, on December the 1st, and that's the declaration of the stock split. You needed a memo entry for that. And the same thing for December the 15th, the actual date of distribution. So you needed to get that. Now, Part B was a little more complicated in that you needed to keep track of the opening balances and all the transactions that went through. So in this case, the common shares, the dollar value, $7.25 was what was in the opening balance. They tell us right in the question that's what's in shareholders' equity. And the stock dividend created $126,750 of common share capital. That's right out of the journal entry. And the number of shares, we started with 65,000. And when we declared that stock dividend, we issued another 9,750 shares for a total of 74,750. And remember how we always charge the dividend against retained earnings? It started with 100,000. We charge 126,000, so we actually have a small negative here to begin with. But then we add the net income to it. And when you add the net income to it, which they tell us is 125,000, you end up with retained earnings of 98,250. On the stock split, there's no impact here on the dollar value or the GL account for common shares, but we issued 3 shares for every 1 old common share. So we need to increase this by 3 times, well, the 74,000 by 3 times. We end up at 224,250. And then the total shareholders' equity should just be the common share amount plus the retained earnings should equal the total, which is 950,000. And that's the solution to exam number 1. Pardon me, exam number 2.